Today is Wednesday, the 6th of May, 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. Let's recap a bit this week because actually we are going into the overarching theme of valuation, and we are using the operation or the advisory board operating system to help to bring the company to a better lens when they are looking into evaluating. If you are looking for raising capital, if you're looking for explain to your shareholders what's going on, if you're looking for lending or looking into, if you're in the European Union, there are different banks and different institutions or private or venture capital or private equity. So valuation always is a very important thing, and it's very important also to anticipate these questions before you go into the market. And many people do it very, very well. Other people think that actually it's a matter of a very good pitch deck. But there's several things that we have to address before going into pitch decks and connecting with people. So let's bring the model up. So I'm going to explain what we covered this week so far. On Monday, we talk about scaling and the commercial acceleration. What is it, the part in brand, your teams, your people, and the partnerships that are required in terms to build a very, very good story on scaling your company, which is the difference between scaling and growing. Is that scaling, you do the same things that you do and they increase the revenue, right? Now, on Tuesday, we have a different conversation, but actually that is happening at the same time, which is when you talk to your partnership or how your partnerships help you to grow or not, in terms of your revenues and what are the assets, intellectual property, etc., implied in that things. So this is yesterday we spoke about predictability, how you can be more certain. Obviously, nobody knows the future, but actually how you plan or the systems or methods or contracts or partnerships and the assets that make this revenue more predictable, and that allows you to go and raise capital and grow. And grow is when you invest. So many you have more investment, more expenditure to increase your revenues, right? So scaling is you have the baseline and the revenues increases. When you're growing, everything grows. So you have more expenses, more personnel, more activities, but with the aim of increasing your revenues too. And today is what is a mechanism that allows you to do that, right? So you have your performances, your governance, risk and compliance, and obviously your assets. And these are the systems, and systems not necessarily are all the time software. The system, your workflows, how you operate, which is procedures that you have, your triage, who we need to call, when, why, and which is a path of escalation that we need to go. So if things start to get complex, etc., etc. So these are your controls and resilience, right? Okay, so this is the overview of the week, and what we are going to talk about today. So when we're talking about from the valuation lens, what I would like to address particularly in this model is the portion that is the risks, right? Because when you're looking into exit, a buyer or when you're looking for capital, an investor does not mind every risk. What they really look is into the hidden risks, the things actually have not been addressed, or I heard this many, many times. We're going to cross that bridge when we get there. It seems to be like a pushing the problem forward when in reality, at least you have to have an idea what that bridge looks like, if there is a bridge, either way, and how you're going to mitigate, or at least to have an idea of how you're going to mitigate those issues, right? So the valuation multiplier of your company comes when revenue becomes more predictable, dependencies start to be reduced, and risk becomes more visible and manageable, right? So when you have these three things, revenues predictable, dependencies reduced, and risk more manageable, buyers feel more confident, and that's what it builds trust, which is what we mentioned yesterday. So and this confidence helps your multipliers to multiply. So we we were talking with companies that their company at the initial valuation was a 3 to 2.5 multiples, and then after several treatments on these areas, we managed to get them valued at 6 multiples, and you say almost doubled. And how much that means in your bank account, right? As a partner, as a shareholder, as a founder, it's a big difference. And the good thing is actually you are leaving a company, or you are handing over a company that has a future. So you are doing a very good job at the same time that you are compensated for that. So here's where I would say founders, particularly founders and solopreneurs, get very, very annoyed, particularly when they go into from building a company to 50 employees or more, and 10 or 25 million pounds or dollars or euros in revenues. And they start to get annoyed with this because the wording sounds heavy, right? And I mentioned a few of them: governance, taxes, accounting, legal structure, intellectual property, controls, contracts, reporting risks. So this is and some founders hear those words and think that this is slowing the business down. This is not what I want to do. This is not the time that I want to spend with people. I want to go to a new market. I want to do something different in terms of my edge, my innovation, my transformation, right? I want to go global. But probably what they mean is not slowing the business down. What they mean is slowing me down, which is a big difference. Because at the speed that you brought the company today is not the speed that the market, the investors, the capital, the taxman, the infrastructure in terms of attracting better or bigger investors are looking for. So it's not slowing you down, it's actually building the foundations so that can accelerate the company later on, right? So that is pretty much these things that are not there to slow a business down. They are there to stop the business from breaking when it start to speed up, right? When they start to accelerate. Now, let's take a look at 3 problems to consider with this context. The first one is that weak structures makes good ambition harder to trust, right? So if you have a structure that is weak, and I mentioned what a weak structure looks like. So if you as a founder, or your executive team, or you as a board member cannot clearly see where your intellectual property sits, which entity owns the assets, who signs a contract with the right delegation of authority, how revenue is booked, where liability sits, on how tax is handled, particularly when you're in different geographies or different jurisdictions, then your valuation start to suffer because it's going to be discounted, as called it, discounted, meaning that actually you're not going to be given a higher multiple, 6 EBITDA, 7 EBITDA, or 4 EBITDA, because there is a risk there that structurally, the next person or the next team that's going to take over the company, they have to fix all that. So it's a lot of time trying to put the things together so they can scale or grow the company. So the business may be good, no question about it, but the buyer sees more work and risks and delays, because this is effectively what may happen. The second thing that consider is the weak systems create operational noise. So if you have more customers, more partners, more contracts, and it's more about everything, more data, more reporting packs, but not necessarily means that everything is true. So if the board or the executive team or you as a founder receive more information and understand less what is going on, the company does not have a better governance, really. It has a better looking confusion, right? So you can have a fancy dashboard. You can say, oh, we're going to use AI to assist us with the data mining and put a fancy dashboard, etc., etc. But if the system underlying that builds these things is not very well designed, and systems, I mean actually the workflow, the operational procedures, the triage, who is responsible for what, when, and why, etc., are not very well structured and planned. Pretty much what you are creating is a very good looking confusion, right? And pretty much it's very hard to understand what the business is doing when you start to do due diligence. The third thing that I would like to consider as a problem to address as the earliest possible is the weak controls are now a real company issue, a board issue, an executive team issue, a founder's issue. And this is, and I'm going to use an example here from the UK because actually it's very, very clear and you can check all the processes. And the good thing about this is that you have already a template, a blueprint that you can copy in any geography, any jurisdiction, and you don't have to reinvent the wheel. And this is the Financial Conduct Authority in the UK, the Operational Resilience, which is an update that they required by March last year for businesses to review and improve resilience after mapping and testing all their operation activities. So what this means is that the companies have to review their important business services, impact tolerances, and mapping at least annually, or when a material change occurs. A material change is something actually alterates what the company have designed initially, and now we have to change it for something else, right? So what is the Financial Conduct Authority saying? Actually, you have to map what you do, understand your risk, put it together with evidence, actually you address them, and then review that again and again and again. And this is all about resilience and efficiency of the companies. And now if a regulator is asking you to do this, why you wouldn't do it? But particularly if you already have a full map of a structure or in guidance how to do it and it's publicly available online. Now, you say, well, what I have to do with this, actually, some things are not required for me to do because I don't have to do. And I give you an example because this is very, very relevant to everybody, which is cybersecurity. So the National Cybersecurity Center published a survey 25-26, and they say that security breaches, 43% of companies in UK reported a breach or an attack in the last 12 months, meaning that actually from last quarter 2026, the survey went back to 2025. And I say, well, that's not my company. I don't have these security breaches, but I guess that you probably have emails from scammers, text messages, WhatsApp messages, phone calls. So where those are coming from, how they got your information. And I'm speaking with people that they've been scammed with something that they understand now that they were very clever because the information that they provided when they call it pitching or phishing, sorry, it's is so close to their businesses that they don't understand that actually this is a scam because they are so close, it's so well disguised that actually you click on that link or answer that call or give information away without realizing until it's too late. And why that is happening, right? Because it's not your own cybersecurity problem. It's actually somebody acquired your data somewhere else. And I gave this particular year was very, very remarkable. The breach that happened with the third largest electrical company, electricity supplier in Spain. They pretty much hacked the database and get everything from everybody, allegedly, and because nobody knows exactly, and still under investigation, exactly the depth of the breach. But email addresses, passwords, account numbers, credit card numbers, bank account numbers, names, addresses, physical addresses. So you start to get, and I hear people that are telling me the amount of emails that are coming close to their daily activities that are very, very concerning. Like I say, like, I don't know if you heard of one. I said, Dad, I changed my phone number. This is my new WhatsApp me. When you WhatsApp that number, guess what? They already start to put a Trojan or links, etc., etc. Trojan means a little bug that actually start to nest in your systems and start to provide information to the person that have in the other side. So why I'm saying all these things, because besides your own controls, and even if you say it doesn't affect me, it will affect you. So you have to have these mechanisms of controls. So in other words, systems are like the office keys or the alarms testing or the fire exit testing, right? So nobody gets excited about them. But when something goes wrong, everybody asks why they were not sorted earlier, because the doors were locked, or the alarms were not working, or the batteries were gone, or the keys where they supposed to be were not there because were in somebody's belt or car or van, etc., etc. So you get the picture. So what is a better question to ask them? So what must be cleaned up before growth make the mess harder to fix? Then this is a question that you have to ask to your organization, where you have all these systems and processes that you need to get all well aligned and prepared and documented with enough evidence to say, yes, this is what we do, this is how it works. So as a board advisor, what I would propose to consider is the following. Number one, build a structure map. And that means that show where is every one of your entities, show who owns what, show where the intellectual property sits, show which contracts belong to which company, right? So if you have several companies, where belongs each one of them. What is your debt, your liabilities, your tax exposure, your reporting duties. So avoid anything that is a guess. Avoid anything that looks like we have created a model to introduce you to. Provide everything with enough evidence that is no doubt of how your company is structured. And the second point is build an operational map. So you have the structure now you have your operation, how you work the things around. Who is a key, which are the key processes, the sales, the onboarding, the delivery, the support, the finance, the compliance, data and escalation. So all these have to be very well mapped. So then when you have your structure, you have your operations, and then that as which of these still depends too much on whom, so you start to de-risk the dependability on founders or certain key people in organizations or the board. And yesterday we had a very interesting conversation where a new sales process was tested by the founder itself, right? It could be the figure that actually everybody trusts publicly, but how it comes that a new sales process for a new product had to be tested by the founder itself. That shows you that is a massive bottleneck there in terms of going to market, because the founder, why or what is the need for a founder to do cold callings or to do explanation of the business on the new product and service? That is a very risky position, because if the founder have to test absolutely everything in terms of operationality to go to market, then what happens when the founder is not there anymore? Who is going to do those tests and establish if it's the right thing to do or what is the wrong thing to do, or which will be the right mechanism to sell those products and services? And the third thing, when you have your structures and you have your operations, then what is the hovering risk that you have to address? So list the issues an investor or a buyer or regulator, insurer, or a serious partner will find. So accounting gaps, intellectual property gaps, contracts, cyber gaps, taxing gaps, reporting gaps, insurance, you name it. So then decide what gets fixed in the next 30, 60, and 90 days. Because once you have all these risks mapped out and actually you have a timeline to fix them, so then the whole structure, the operations start to get more solid, because you start to understand how all these things that actually may affect the valuation of the company, particularly when you're going to looking for capital or to explain to shareholders or looking for more capital from your shareholders or to investment banks or whatever is the case, you have all these three layers very well clear laid out and explained with evidence. So what's the next challenge? Who helps you to turn this cleanup into a growth system like the model that we have in front of us, without building a heavy corporate machine too early? Because you don't want to have more managers or people advising that actually people doing the job. So that's where I come in, and I provide three very distinctive things: business outcomes, differentiators, and a risk reduction. So what you gain in terms of business outcomes is that I help you as a founder, as an executive director or a managing director or executive team members and board members to structure or to turn the structure, the governance, the controls and reporting into a practical operation system. So the company becomes easier to understand, easier to fund, easier to partner with, and easier to protect, right? In terms of differentiator, I built an international advisory board around the systems gap in front of the company, or what is happening in the company today. That may include governance, risk and compliance, taxation, accounting, intellectual property, cyber or cybersecurity, legal, investor readiness, reporting and operating design. And all this model works with a rotating member pool that actually brings the expertise as the next milestones come in front of the company every 6 months or every year. And in terms of helping to reduce risk, this model reduces the risk of scaling into confusion. It also reduces the risk of going to investor with gaps that damage your trust. And the company gets specialist support milestone by milestone, as I mentioned, without hiring one expensive executive too early and then later on saying, was very useful, was very skilled, provide a lot of value for 6 months, a year, and then what we're going to do with this person, right? So that also reduces the risk on that point. So to wrap up today, one action you can take in half an hour or less. Before your next meeting, ask for a one-page system scorecard with 3 columns: governance, risk and compliance, performances, and assets. And mark each one as red, green, or amber. And the reason of marking these traffic light colors is the sentence of the evidence for each score. So if your governance, risk and compliance are sounding green, put the evidence, put a sentence that gives the evidence that has a sounding green. If you're not so sure, put it a yellow, and why this you're not so sure about this is a sounding green, and the same for red. Put the sentence and say, well, we don't have ABC that actually makes a red here, so we can address this in the next 30, 60, or 90 days. So finally, if you want an international advisory board to help you to organization strength controls, clean up structure, protect assets, and build the operating spine needed for valuation readiness, let's have a 30-minute call so I can understand where you are today, what you want to achieve, and how international advisory board can help you move faster without hiring one permanent executive or paying big consultants overhead. Let's pause here today and reconvene tomorrow then, because tomorrow I will move from systems to edge, because the transformation, the innovation of the company is once the company is cleaner. So the board or your executive team or yourself as a founder must protect what makes it worth investing in your company, and how we're going to do that. Have a great day, and I'll see you tomorrow. Thank you.